After studying this module, we shall be able to know the concept of break-even analysis and break-even point, learn the concept of break-even chart and its uses, understand the concept of cash break-even point and related fixed cost, evaluate the financial break-even point, and evaluate the composite break-even point.
Break-even analysis is a subset of cost volume profit analysis which is used by the management to help to understand the relationship between the variables, namely cost, sales volume and profit. This technique is at the heart of CVP analysis. It focuses on how selling price, sales volume, variable cost, fixed cost and the mix of the products sold affects the profits of the firm. It is an important technique of CVP analysis. Break-even point is that level of output at which the total cost equals or break-evens the total revenues of the firm. That is, at this point the firm is just covering its total cost including fixed as well as variable cost, and the firm is neither earning any profit nor incurring any loss. While knowing this break-even point is important, this point of no profit and no loss is not the only objective of any business firm, but most business firms hope to do better than this break-even point. Generally, the small business owners, they have an idea in their mind to achieve a target profit level before starting any business, and break-even analysis helps them to find out the desired level of sales to earn that target level of profit.
Break-even analysis is also useful in finding out the margin of safety for the firm, which is amount of actual sales over and above the break-even sales. Break-even analysis may be defined as a mechanism in which the relationship between the variables named as cost of production, volume of production, sales, and profit is determined, and a detailed analysis is done as to see the impact on profits due to changes in any of these variables. In narrow sense, break-even analysis helps to find out no profit no loss level of output, but in the broader sense, it is used to find out profit or loss of the business firm at any given level of output, and also the volume of sales or desired sales to earn a target profit. The break-even point is the sales level at which contribution margin is just equal to fixed cost and the firm has no profit and no loss. At break-even sales level, the total cost, that is, the fixed cost as well as the variable costs, are just covered. Any sales level below the break-even point will therefore result in loss, and the sales level above the break-even point will bring profits to the firm. Once the break-even sales level is achieved, the net profit will increase by the amount of unit contribution.
Break-even analysis is an important technique of CVP analysis. It is actually a subset of CVP analysis. It is the starting point in any business planning and tells the business firms about its no profit, no loss level of output. That is, at what level of output the firm will be able to cover its entire cost, including fixed cost as well as the variable cost. But achieving this point of no profit and no loss is not the only objective of any business firm, but generally the business firm aspire to do better than this break-even point. In the starting, generally business firms have some target profit in their mind, and this break-even analysis technique helps them to find out the target level of sales with which they will be able to achieve this target level of profit. That is, how much sales are required to earn this target profit. Break-even analysis is a mechanism in which the relationship between the variables, namely variable cost, cost of production, volume of production, sales and profit is determined, and a detailed analysis of the same is done to analyze what will be the impact on profits of the firm due to changes in any of these variables. Also, break-even analysis helps to determine the probable profits of the firm for any given level of activity or output. Therefore, these two terms, break-even analysis and CVP analysis, are generally used interchangeably in place of each other because idea behind the two is the same. Both these techniques provides an insight into what will be the impact on the profits of the firm due to changes in any of the variables, namely cost, selling price, volume of output, etc. Break-even point is that level of output at which the total cost break-evens or equals the total revenues of the firm. The contribution margin per unit is available for the recovery of fixed cost and secondly to contribute towards the profits of the firm. The contribution margin is already obtained after deducting the variable cost from the selling price. Since fixed cost remains same during a period, the firm must sell enough units to generate sufficient total contribution margin which is at least equal to total fixed cost of the firm so that the firm is not incurring any losses. The break-even point is the sales level at which the contribution margin is just equal to total cost, that is the fixed cost as well as the variable cost. Any sales below the break-even point will therefore result in loss and any sales level above the break-even point will generate profits for the firm. Once the break-even sales are achieved, the net profit will increase by the amount of unit contribution. At break-even point, profit being zero, the contribution margin is equal to fixed cost.
Break-even analysis is based on certain assumptions which must be considered while making decisions using this technique. These assumptions are: number 1, all the costs can be classified as either fixed cost or variable cost. If there is any semi-variable cost, then it is assumed that it must also be capable of being classified into fixed and variable components. Number 2, fixed costs are assumed to remain constant irrespective of changes in the level of output. Number 3, there exists a linear relationship between variable cost and level of output, that is, the variable cost changes at a linear rate in response to changes in the level of output, implying that per unit variable cost is same for all the levels of output. Fourth, break-even analysis assumes that the selling price do not change as the level of sales volume changes. Number 5, it is assumed that there is no change in the level of inventory. The number of units of sales will coincide with the number of units of production so that inventory may remain constant. Number 6, the basic managerial policies are assumed to remain unchanged. For example, there is no change in manufacturing methods or product specifications. Number 7, break-even analysis assumes that period of consideration to be short enough so that the concept of time value of money becomes irrelevant and therefore no need to take care of it. Number 8, the operating efficiency or productivity of the firm is assumed to remain constant and it will not increase or decrease with the change in level of output. That is, there is no concept of economies or diseconomies of scale. Number 9, the product mix is assumed to be constant. Break-even sales level may be computed for a product or for the group of products or for the entire firm. All the costs, that is fixed cost or the variable cost of the manufacturing or non-manufacturing operations must be incorporated in the calculations of the break-even point. It may be noted that the break-even sales level is the minimum sales level the firm must achieve to incur no loss, but in no case it should be taken to imply a desirable sales level. No firm in the long run can survive by operating at the break-even point of sales only. The break-even analysis may be explained in mathematical mode in the form of break-even equation or in the graphical mode. The break-even equation may be derived from the basic relationship between sales and profit. We know that net profit is equal to sales minus variable cost minus fixed cost, or sales is equal to variable cost plus fixed cost plus net profit. We also know that sales is equal to number of units sold multiplied by selling price per unit. Thus, we can represent this equation as N multiplied by selling price, which is same as N multiplied by variable cost plus fixed cost plus net profit. As we know, at the break-even level, the profit is 0, that is, NP is 0, therefore, the equation can be written as N multiplied by selling price is equal to N multiplied by variable cost plus fixed cost. Or, in other words, we can say that N multiplied by selling price minus variable cost is equal to fixed cost, or N is equal to fixed cost divided by selling price minus variable cost. And we have already explained selling price minus variable cost is equal to contribution per unit. Thus, we can say that N is equal to fixed cost divided by contribution margin per unit. Break-even point in units can be computed as fixed cost divided by contribution margin per unit, and break-even point in terms of value can be computed as fixed cost divided by contribution sales ratio. Also, break-even point in value is equal to fixed cost divided by PV ratio, where contribution sales ratio or PV ratio is equal to contribution margin divided by sales whole multiplied by 100. Thus, we see that the break-even analysis can be done by determining the value of one or more of these variables. If the selling price is known, we can find out the number of units to be sold to break even. If number of units expected to be sold are known, we can use this equation to find out the minimum selling price to break even.
The graphical presentation of the break-even analysis is done with the help of break-even chart, which is also called CVP chart or graph. It is very useful device for presenting to the management the information showing the effect of changes in cost and revenues for different level of outputs on the profits of the firm. It is an elementary form of profit graph which is easily understandable. With the help of a graph, we can show the meaning of thousands of words in a single picture. When the relationship of cost, volume of output and profit is plotted graphically, the obtained picture or diagram is called the break-even chart or the break-even graph. The break-even chart shows not only the point where the total cost and total revenues would break even, but also it represents the behavior of cost, revenues and profits at different level of output. In other words, a break-even chart is a pictorial representation of the relationship between cost, volume, selling price and profits of a firm and shows graphically the effects of changes in any of these variables on the profitability of the firm.
Break-even chart shows graphically the following. Number 1, the probable profits or losses of the firm at different levels of output. Number 2, the relationship between variable cost and fixed cost. Number 3, the level of output at which the firm break-evens, that is, the level of break-even point. Number 4, the margin of safety, which will be discussed later in this module. Number 5, the angle of incidence, that is, the angle made by the total sales line and total cost line at the break-even point. A large angle of incidence shows high rate of profit and vice versa. Number 6, the level of contribution or PV ratio, if required, may also be shown. The break-even chart or graph may be drawn by considering and taking the following steps. Volume in number of units is taken as the horizontal axis and the costs and sales revenues are taken on the vertical axis. A parallel line to the volume axis, that is horizontal. Now let us discuss some uses of the break-even chart. Number 1, it provides detailed and clearly understandable information. A break-even chart shows the information very clearly, and a look at a glance will give the whole idea about the relationship or the behavior of the variables, namely cost, selling price, volume of output, and profits of the firm. Number 2, it depicts profitability of the products. Besides the break-even point, where the business is in no profit and no loss situation, the break-even chart also shows the profitability of different products and thus helps in managerial decisions regarding shutdown or continuation of a product or the business as a whole. Number 3, it shows the effect of changes in cost and selling price on profits. Break-even chart demonstrates very clearly the effects of changes in fixed cost, variable cost, and selling price on the profits of the firm for different levels of output and therefore helps the management in taking decisions accordingly. Number 4, it helps in cost control. The break-even chart shows fixed cost graphically in the total cost of the product, and if the fixed costs are high, the management can take the corrective actions to control the costs like elimination of wastage, improved efficiency, etc. Number 5, comparative efficiency of the plants can be analyzed. The break-even chart can be used for analyzing comparative plant efficiencies. The efficiency of output at a particular plant is shown by the angle of incidence made at the intersection of total sales line and total variable cost line. Number 6, it helps in forecasting and long-term planning. A break-even chart shows the relationship among the variables, namely cost, selling price, and volume graphically, which helps in forecasting, long-term planning, and stability. Let us now discuss different types of break-even points. There are three types of break-even points. Number 1, cash break-even point. Number 2, financial break-even point. And number 3, composite break-even point.
Cash break-even point may be defined as that level of output and sales at which the total cash cost equals to total sales revenue so that there is neither cash profit nor any cash loss. In other words, we can say that cash break-even point is that level of output at which the cash inflows, that is cash sales, are just equal to the immediate cash requirements of the business firm. It is an important concept in the case of operating plants. If in the short run a producer is able to achieve cash break-even point, he can take care of the temporary difficulty. But if the output is below the cash break-even point, in that case the producer is in real difficulty.
For computing cash break-even point, the fixed costs are classified into two. Number 1, cash fixed cost. These costs do require immediate cash payment in cash. For example, salaries of the permanent staff, rent, insurance, fixed rental for power, telephone, etc. And number 2, non-cash fixed cost. Such costs do not require immediate cash payment. Depreciation, writing off deferred revenue expenditure, goodwill, notional fixed cost, etc. are some examples of non-cash fixed cost. To compute cash break-even point, only cash fixed costs are considered. The cash break-even point may be computed as cash break-even point is equal to cash fixed cost divided by cash contribution per unit, where cash fixed cost is equal to total fixed cost minus known cash fixed cost. Cash break-even point in units may be computed as cash fixed cost divided by cash contribution per unit, and cash break-even point in rupee terms may be computed as cash fixed cost divided by PV ratio. Let us assume that the total fixed cost of a firm for the year 2013-14 is rupees 21,40,000, which includes a depreciation of machinery amounting to rupees 2 lakh, notional rent of the building rupee 1 lakh, and a deferred revenue expenditure of rupees 40,000. If the selling price per unit is rupees 300 and the variable cost per unit is rupees 200, then the cash break-even point may be computed as shown here. First of all, we'll compute cash contribution per unit, which is rupees 300 minus rupees 200 is equal to rupees 100. Cash fixed cost is equal to total fixed cost minus non-cash fixed cost, that is 21 lakh 40,000, the amount of fixed cost minus non-cash fixed cost, which is the sum total of 2 lakhs plus 1 lakhs plus 40,000. Therefore, the cash fixed cost comes out to be rupees 18 lakhs. Cash break-even point in units is equal to cash fixed cost divided by cash contribution per unit. That is 18 lakhs divided by rupee 100, which comes out to be 18,000 units. And cash break-even point in rupee terms is equal to number of units of the break-even point multiplied by selling price per unit, which is 18,000 units multiplied by rupees 300 per unit, which comes out to be rupees 54 lakhs. Cash break-even point in rupee terms is also computed as cash fixed cost divided by PV ratio, which is 18 lakhs divided by 300 selling price minus 200 variable cost whole divided by 300, which is selling price, and the whole multiplied by 100, which comes out to be rupees 54 lakhs. Financial break-even point is that level of earning before interest and taxes at which the firm is able to cover all the fixed financial charges, that is interest and preference dividend. As preference dividend is not a deductible expense, so the amount of dividend is to be grossed up. Financial break-even point is the level of earnings at which the earning per share is equal to zero. The higher the value of financial break-even point, the higher the financial risk of investment in the firm's stock. Financial break-even point may be computed as I, that is interest, plus PD, that is preference dividend, divided by 1 minus T, that is tax rate. In case earning before interest and taxes is less than the financial break-even point, then the earning per share will be negative. At the financial break-even point, the earning per share is equal to 0. Any increase in the level of earning before interest and taxes beyond the financial break-even point raises the earning per share more than proportionate increase in the earning before interest and taxes. Let us consider an example. Suppose the share capital of a firm is in the form of equity shares of rupees 10 each and the amount of equity shares is rupees 7 lakh. 14% preference shares of rupees 100 each, the amount is rupees 3 lakhs. 16% debentures, the amount is rupees 2 lakhs, and the tax rate is 40%. Now, interest on debentures is rupees 2 lakh multiplied by 16 divided by 100, which comes out to be rupees 32,000. Preference dividend is rupees 3 lakhs multiplied by 14 divided by 100, which comes out to be rupees 42,000. Now, the financial break-even point is equal to interest plus preference dividend divided by 1 minus tax rate, which is 32,000 plus 42,000 divided by 1 minus 0.4, which comes out to be rupees 1,02,000. Composite break-even point. If a firm manufactures more than one product, in such a case, the break-even point is to be computed considering all the products together. Such a break-even point is called composite break-even point. For computing the composite break-even point, the problem is that in what proportion the sales of different products would take place. Let us assume that there are two products A and B. In this case, total contribution is equal to contribution per unit of product A multiplied by number of units of product A plus contribution per unit of product B multiplied by number of units of product B. Now, the composite break-even point is equal to total fixed cost divided by the composite PV ratio, that is, total fixed cost divided by total contribution multiplied by total sales. Now, in the case of variable product mix, the product giving highest contribution per unit or highest PV ratio is manufactured first. The other remaining products are manufactured in the descending order of contribution per unit or PV ratio.
Let us now quickly summarize what we have learnt in this module. Break-even analysis is a CVP analysis technique used for managerial decision making. Break-even analysis studies the impact of changes in cost, selling price, volume of output, etc. on the profits of the firm. At break-even point, the firm generates a contribution which is just equal to its fixed cost, and the firm is not earning any profit nor incurring any loss. At break-even point, the total cost of the firm, including fixed cost as well as the variable cost, are just equal to its total sales revenues. Any sales after the break-even point will contribute towards the profits of the firm. The break-even chart is a graphical or pictorial representation of the relationship between cost, variable cost, total cost, sales, and profits of the firm. Cash break-even point is that level of output at which total cash cost of the firm is equal to total sales revenue and there is no cash profit and no cash loss. For calculating the cash break-even point, the total cost is divided into cash cost and non-cash cost. It is an important concept generally in the case of operating plants or manufacturing plants. Financial break-even point is that level of EBIT, that is earning before interest and taxes, at which the firm is able to cover its all fixed financial charges, that is the interest and preference dividend. At financial break-even point, the earning price per share of the firm is 0. If EBIT, that is earning before interest and taxes, is less than this financial break-even point, then the earning per share will be negative. And if EBIT, that is earning before interest and taxes of the firm, is higher than the financial break-even point, in that case earning per share of the firm will be positive. Composite break-even point is relevant only for the multi-product firms. In such a case, break-even point is calculated considering the contribution of all the products together. Composite break-even point is computed as total fixed cost divided by composite PV ratio. A composite PV ratio considers the pool of contribution of all the products taken together instead of contribution of the individual products.